Hi everyone, today we're going to talk about Honest stock and we're going to see what went wrong for this company after they reported earnings this week. Now, after this week's earnings, the stock tanked an absolutely huge amount. The stock crashed over 20%. So we're going to look at this stock and go, what went wrong for it? Is there any lessons that we can learn from this? And going forward, is there potentially a good investment here or is it one to avoid? So yeah, I thought I'd take a look at this one. Hope you enjoyed it and we'll have a look. So after reporting earnings, Honest company was down 22% on Friday and it's now currently valued at $4.68. The ticker symbol is HNST and it's currently a 426 million market cap company. Now, even though it's down at $4.68, it's actually been an ugly year, maybe even longer than that for Honest. So since the stock IPO'd around May time, the stock actually came on at $19. You'll see the stock is actually down 75%, and even this year the stock is still down 42%. So it's been an ugly month for Honest, an ugly 2020 for Honest, and an ugly since it's been on stock market for Honest basically. So the drop was originally off their earnings. So their earnings came out, the actual numbers weren't too good, but it was the outlook that was the absolute horrible thing for them. So Honest expects 2022 revenue to be approximately 380 million in 2021. Consensus was 366 million. So this is a massive drop. The consensus was way from what analysts were expecting, what pretty much everyone's expecting is way off what was expected, and this is horrible. This is a massive decrease in their revenue, and this is offering for a company that is basically a growth company to come out and have flat revenue is very poor. And the Q1 is expected, this was the worst bit, the Q1 revenue is expected to decline 15% year over year from 6 to 8 million to consensus estimate of 91 million, which is shocking. So the Q1 in particular was poor. Now I was very surprised to see that they expect Q2, Q3, Q4 to be good amounts of growth for them, and yet Q1 is going to be horrible. Now obviously they know a bit more than us because they're pretty much all the way through Q1 already, with it being towards like the last week of it basically. But I am really surprised to think that they can do this horrible Q1 and then as soon as the rest of the quarters come to then be like to rebound from 15% to not decent growth, because flat growth is still shocking, but single digit growth to kind of recover some of this decline in Q1. So I was really surprised to see that surprise on the guidance, but this is way under what was expected. Now sometimes I call this the analyst trap, and this can sometimes happen. It happened with Gang basically when they reported earnings last week. So sometimes people make this mistake by following analyst predictions. So what can happen is basically analysts are trying to predict numbers, and what they can do is predict numbers as much as they want. Now what can happen sometimes is an analyst will predict these numbers, so let's say this red chart here, and what their actual financials are always under what analysts expected. But if you look, they're always under what's expected, but they're always uptrending in the right direction. Now just because a company misses analyst expectations, it doesn't mean it's a bad company. It can still be a very good investment, because as long as the financials move in the right direction, then that will be, normally turn out to be still a pretty good investment. So don't get too caught up on analysis numbers if they do miss them. As long as the company is still moving in the right direction, just because it misses numbers doesn't mean it's a poor company, as long as the financials are pretty much moving in the right direction. And that's what Gang had. Gang reported earnings, it dropped, and you looked at it and went, well, yeah, it missed analyst projections by that much, but look at the big picture, look at that upward trend. And that's what sometimes people fall into the analyst trap and looking at analyst numbers and not actually looking at what the company is doing financially wise. Now that was for Gang, this is for Honest. Now Honest actually did the opposite. They actually, if you look at analyst predictions and then you look at Honest numbers, that is Honest. This is where they ended up going. They're way off an uptrend. So when you have a company that doesn't fundamentally improve year after year or stops improving, which with this forecast would suggest, then that's where you have the problem. So this here was a massive shock for investors, for Wall Street, and that's what's caused a massive decline, because the company is no longer moving in the right direction. Now Honest itself sells products that are baby diapers, beauty, bathroom, body products, which already starts sending a bit of warning flags off for me. This is I looked at this a while ago, and this is why I never bought it. Already in a massive competitive space. Now the moat on this one is that it's going to sell clean ingredients, it's going to be sustainable products, and this is its selling point, that this is what it's working on. Now straight away, this for me is an area I would not touch. It's already ultra competitive, it's very price competitive as well, and it's not a really big growth area. When I buy stocks, I like to have growth areas because you have new customers coming in all the time. With this, it's basically trying to take market share from other companies, and quite often to do that, you need to have price competitive products, you need to spend a lot of marketing, which is not very good. So that's why I don't touch it. So straight away, it's an area which, it's not like a telehealth area that's going to grow massive over the next few years, and that's new customers coming in all the time. time. It's a very competitive area, very price competitive as well. So already the moat on this isn't strong, and it's in a very competitive area, which I do not like. So that's what the company does itself. Now getting on to the actual numbers, what I saw is management actually trying to blag it and making it look a good quarter. Like the first paragraph or first couple of paragraphs, there was no actual post of what the company actually did revenue wise until further down the line. So they made it look like, oh, we increased 19%, we increased 13% in core products. But that wasn't the actual revenue. You have to go all the way down here to actually get the proper revenue. Now, the actual revenue was 3%, which is very poor once again for a growth company. And this is a key thing, you know, to have a successful company, you need to have revenue and profit moving in the right direction. And sure, it's moving in the right direction slowly, but not for a growth company. For a growth company to keep up the valuation that it has, you need to be growing revenue at a massive rate, and this doesn't happen. You know, if it's a value company, you need profit and revenue to grow. If it's a growth company, you need to have revenue growing at a really good rate, and then think, okay, how much is that going to get down to the bottom line in a few years' time? And you have nothing with this company, which is the problem. Now, the good thing, there is some positives here, which is that diapers and wipers did grow 16%. Skin and personal care did grow 26%. But the massive reduction was this area here, which was household and wellness, which decreased 68%. Now, they did say that was a lot of it because of COVID-19, and a lot of that was because of sanitizer and everything like that. Yeah, I thought, you know, there will be a bit of a decrease here, but I mean, 68%, that's a massive amount. But this then goes back to the previous guidance, which I was thinking, well, you know, the look at here that once again say that a lot of this was, you know, you look at the guidance here and you think it's okay, it's going to be flat guidance, and you look at the numbers previously and you think, well, how are they getting flat? Because the tough comparisons are pretty much out the window for this now. You know, a lot of the tough comparisons would have been in 2021, so I can't see that problem. And then I'm thinking, well, this is growing 19%, this is growing 26%, this is growing 16%. How come that this is only going to be flat when all these are growing double digit? And obviously, they're quite far into Q1 now, so I was quite worried on the guidance side of it, thinking, you know, the growth story is just absolutely gone on this company right now. And then you go to the next problem, which is company is the losses they're having. You know, they currently make revenue of 80 million. The cost of revenue is 56 million, so the margins are razor thin. You know, 24 million down to gross profit. That is to, you know, the cost to make the product to sell it. And then you start adding the selling and general admin on is 18 million, which is nearly the amount of the gross profit nearly. And then you got marketing of 12 million, which is, you know, right here. And you got research and development of 1.5 million. You know, your total operating expenses are huge. So, you know, you're making an operating loss here of 8 million before taxes and everything like that. It's going to be really hard, you know, at the moment for this to get anywhere near profitability. You know, you're going to cut you're going to either have to cut your marketing down, and then if you're cutting your marketing down, then you're probably going to be, you know, taking less market share, or if you're going to increase some gross profit margins, you're going to have to sell your product for more. Once again, you're going to lose market share because people say, oh, your product's too expensive. Do you cut your selling general and admin down? It's just, you know, this is, you know, a company that you either have a company here that has growth, which this doesn't have, or you have a value company which has good amounts of profit increasing. And this company has neither. It's neither a growth company or a value company, because it offers you no growth and it offers you no profit growth, which is a horrible mix, and that's why you're not having much share price movement. Now, there's not much past financials to go on here because it is a recent IPO, but you can see here 2019, you know, the company lost a lot more money. It moved in right directions. You know, it lost 31 million. Then it lost 14 million, so that it's losing less money, which is good. You look at the revenue growth, it went from 235 million to 300 million. You know, it's growing double digit, 10+%, which is pretty decent. But then you look at the financial year just gone, and it's just gone back from losing 14 million to losing 38 million, and the revenue has gone from 300 million to 380 million, and it's growing single digit. So, you know, this is a problem here. You've got a company that has no profitability, and then you'd say, okay, well, it's a growth company, it's focused on the growth, and it's struggling to grow, which is not the combination that you want. Now, going on to the valuation side of it as well, you can see that it came on at 5 times sales. It then went to 2.5, 1.9, 1.17. I mean, even then, like, this company down at this sort of valuation, it's not great. Like, it's not a great valuation, because you got to remember, you know, for this sort of valuation, you could be picking the likes of Hims up, Gang up, that are growing, you know, a lot closer to profitability, a lot better gross margins. Growing at, you know, for Gang, you're growing at, you know, high 20% rate, and or for Hims, you know, you're growing at 85% rate, and it's not a great valuation either. So even after all this drop here, you know, it's not a company that stands out because it has not much going on for it. So overall, I guess that kind of leaves where Honest is at. What do I think about Honest stock? Well, yeah, it's not great at all. Obviously, the warning signs were there. You know, it's struggling for growth. It's obviously losing a lot of money as well at the same time, and the valuation is not that great on it either. So with that problems that you have here, a competitive space as well. One of the main problems you have is that for a growth company, it's got no growth, and that's not going to attract any investors in. And the thing is, you can't even claim it on a value basis because it's still losing a lot of money. And what do you need to have a successful investment? You need to have, you know, revenue growth, profit growth, and it just doesn't have them. And so a combination of that means that, yeah, you know, when you have a massive dump on the outlook, when it's no growth, it's not a company that you want to be investing in. Now, there is some parts of the company that are still growing at pretty good rates, so it is important to keep an eye on them. And I think the best thing to do with probably Honest is to look at 12 months time, get these horrible quarters out of the way, and then when the company carries on, if then the other parts of the company are still growing at really good rates, then it could potentially come a buy. But at the moment, it's just got not much to offer at the moment. So it's one to stay away from. And for it to come into an investable stock, it either has to go back to growing at very good rates, or the next thing is to start coming into a more of a profitable company. That's the only way it will become a successful investment. So my opinion would be to wait out on this one and just leave it for a few more quarters and see if in them quarters the company carries on having really good growth, shrinks them losses down, and then eventually you could buy the stock. And at the end of the day, if you were to do that, I'm sure potentially, you know, there's a risk that you do maybe miss out on 30-40% return on that one. But when you look at how much it's down, you know, you can work. It's worth waiting and just seeing if the company turns it around before you do buy it. So for me, there's clear problems that what I've gone on here at Honest, and going forward is still a stock that I would not buy until the company starts offering more to its shareholders in terms of either profitability or revenue growth. So I hope you enjoyed the video, guys, and I'll see you in a bit.